Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 5th of February. It's been a generally positive week. There was a stumble midweek when the Federal Reserve Chairman Powell rather closed the door on any potential interest rate cuts in March. May still seems to be the favoured timing for the first cut, but the market managed to get over that towards the end of the week as investors switched their focus back to earnings. 80% of companies out of the S&P 500 who've reported so far have beaten earnings, and there's been a particularly strong showing so far from the technology stocks and the Magnificent Seven in particular, with the possible exception of Apple. So that's been enough to lift markets, and in the year to date the Dow Jones is currently up by 2.2%, the S&P 500 by 2.9%, the Nasdaq by 2.3%, the FTSE 100 is currently drifting, and that's down 1% so far this year. So turning to next week, there's another batch of blue chip earnings to look out for. The first one is a third quarter update from Vodafone. Now, these are shares which have been under some pressure for some time. Over the last year, the price is down by 28%, and they're currently bumping along the bottom at multi-year lows. Any number of reasons for this, not least of which, of course, is in the telecom sector, the massive investments that need to be made into the likes of 5G, for example, with unclear or certainly not immediate returns. Vodafone has had its own specific problems as well. Its most recent disappointment actually came this week. It apparently rejected a proposal to merge its Italian operations with Iliad, which sent the shares a few percent lower. The yield of 11.4% is of course attractive, but by the same token, just bear in mind that some of that yield increase has been by the poor performance of the share price. So we'll need to see what Vodafone's going to do about competition, particularly in Europe, where the ferocity of competition is strong. Fourth quarter full year earnings also due from BP. Shares down around 4% or so over the last year. We've just heard from Shell this week, so a few of the factors that investors will be looking out for will be similar. There was a wavering oil price last year, currently underpinned somewhat, of course, by increased tensions in the Middle East. Also, lower production and refining margins could be a factor, something to look out for. In terms of the financials, the net debt is a figure to watch out for, and the announcement of any potential share buybacks. In the meantime, BP is yielding about 4.9%. Finally, half-year numbers from Barratt Developments. Needless to say, the house building sector has been under pressure, but Barratt Developments has been a bit of a star performer, all things considered. Shares are up about 12% over the last year. Usual things to look out for, of course, in terms of its update, forward sales, its order book, whether it's seeing any recovery in demand now that interest rates in the UK appear to have peaked. So those are things all to look out for. It's also sitting, last we heard, on a cash pile of about £1.1 billion. That's so it can make selective purchases if it likes the price of new land that it's seeing. In the meantime, and despite the recent dividend cut, the shares are still yielding 6.3%. Other FTSE 100 companies reporting next week. We've got full year numbers from British American Tobacco, AstraZeneca and Unilever. Thanks for watching. Have a great week.